All right, let's dive into Carnival Corporation's latest earnings call. Now, on the surface, the numbers, they looked a little weird, a little confusing. But the market's reaction was loud and clear. So let's break down what really went on here.
And when I say loud and clear, I mean it. The stock shot up almost 10% on the day of the release. That is a huge move. So right away, you got to ask yourself, what in the world did Wall Street see in this report to spark such a massive rally?
And that's the big puzzle, right? Because here's the kicker. Carnival missed on revenue, their top-line sales number. Usually, that's poison for a stock. So how on earth does a revenue miss lead to this kind of buying frenzy? That is the exact question we're going to answer today. So here's the game plan. We'll start with that big stock pop, then get into the numbers, the beat versus the miss. After that, we'll unpack the real story, the bull case, look at what management is telling us about the future, and then I'll give you my take on what's next.
Okay, first up, let's take a closer look at that pop. This wasn't some slow burn. The positive vibes were there right from the jump. The stock gapped up in a big way before the market even opened for the day. And that's a huge tell. It means the big money, the institutional players, they'd already dug in and found something they really liked.
And yeah, the data backs this up completely. You can see it here. The stock held those pre-market gains, closing up almost 10% on absolutely massive volume. We're talking 84 million shares traded. And look at the options market. Call option volume, that's the bullish bets, surged nearly 60%. So let's be clear, this wasn't just a little bit of excitement. This was a fundamental re-rating of the stock. The big dogs were buying.
So what exactly did those big players see that got them so excited? Let's get into the actual numbers because this is where all the action is. And you're going to see this really interesting split that basically wrote the story for the quarter. And here we go, piece number one of the puzzle. The bottom line, the profits. It was an absolute blowout. I mean, look at this. Carnival posted 34 cents in adjusted earnings per share. The street was only looking for 25 cents. That is a 36% beat. Just wow. It's a huge sign that they're running the business incredibly well. But here's the full picture. And this is where things get really interesting. You put the revenue and the earnings side by side, and there's the paradox we talked about. Revenue, it came in just a hair under what everyone expected, the tiny miss. So what's the takeaway here? It's that the market just completely shrugged off that tiny revenue miss. They looked right past it and focused 100% on that massive earnings beat and, even more importantly, how they did it. Which brings us to the real heart of it all. Why did the market cheer? Well, it's because when you listen to the earnings call, beyond the headlines, management laid out three massive, game-changing developments that are way more important than a tiny revenue miss.
And here they are, the three big reasons for that rally. First, their balance sheet is finally in great shape. We're talking investment grade. Second, the dividend is back. And third, they gave a super confident outlook for 2026 that was even better than what Wall Street was hoping for.
Let's start with that balance sheet. Management dropped this number 3.4 times. That's their net debt compared to their earnings. Now, to put that into perspective for you, that number was way, way higher just a year ago. Hitting this target, it's a huge deal. It's a massive milestone. It basically signals that the whole post-pandemic financial nightmare is over, and it makes the stock a heck of a lot safer. And having that strong financial house in order immediately unlocked the next big catalyst, bringing back the dividend. They approved a 15-cent per share quarterly dividend. And that's not just about the cash. It's a powerful signal from the boardroom. It screams confidence in their future earnings. It means they've officially shifted from just surviving to thriving and rewarding their shareholders.
And last but not least, they put their money where their mouth is with some really strong guidance. Management said they expect to earn around $2.48 per share in 2026. Wall Street was only modeling $2.43. Now, that might sound like just a nickel, but it's a huge deal. It tells investors that the big beat this quarter wasn't some one-time thing. It's the beginning of a new trend.
Okay, so let's move on to the forward guidance, because it wasn't just about the raw numbers. The whole vibe of the earnings call, the tone from the C-suite, was just as important. They laid out a playbook that clearly got investors fired up.
I mean, this quote from the CEO, Josh Weinstein, really says it all. We are very well positioned to top 2025's fantastic results in 2026. That's the kind of confidence that gets investors excited. They weren't just patting themselves on the back. They were making it crystal clear that 2025 was just the beginning, a launchpad for even bigger things.
And this wasn't just talk. They backed it up with a really solid multi-part plan. They're focused on getting more money per customer while keeping a tight lid on costs.
They're finally addressing the oversupply issue in the Caribbean head-on, and on top of that, you've got this corporate simplification plan and development of brand new destinations like Celebration Key. They've got a lot of levers to pull for future growth.
So where do we go from here? What does all this mean for the stock going forward? All right, time to put on my analyst hat and give you my take.
Bottom line, my rating on Carnival is a firm outperform. After looking at the quality of this report and all the good things they have coming down the pike, it's pretty clear this company has made it through the storm. They're done with recovery mode, and now they're officially playing offense.
And here's a breakdown of my thinking. The biggest piece of the pie, 40%, is that balance sheet strength. It's the foundation for everything else. But then you've got shareholder returns, the dividend, and that strong guidance, which are also absolutely critical. And that corporate unification thing, it might seem small, but it's a sneaky technical catalyst that a lot of people are missing.
And that little piece actually leads to what I think is a really interesting trade idea here. That unification of their corporate structure, it's a bigger deal than it sounds. See, when that happens, it's probably going to trigger a wave of forced buying from big index funds that have to rebalance their portfolios. So a smart way to potentially play this could be using long-dated call options to capture that upside. It's a powerful catalyst that I think is still flying under the radar.
And of course, just a reminder, this is not financial advice. Everything we've discussed today is for educational and informational purposes only.